Hello and welcome to the Abundance Mindset Podcast, where we're committed to providing education that makes financial decisions a little bit simpler for you. Today, we've got a good one where we're talking about patterns that we see for people that have W-2 or regular salary income that are starting to earn more in their lives, and just the common mistakes or things that people aren't thinking of or fail to think of as their lifestyle grows, their income grows, their capacity to save grows. So today we're calling it the high income earner checklist. So what things should we be thinking about?
Yes, I think a lot of high income earners reach this point where, you've been working, you kind of have your systems down for where you save, where you don't, where you spend, right? But then you hit this inflection point where, okay, we're making more and I really want to be efficient. I know that there's this kind of next level. And so I think this podcast is a great place just to start and start asking really good questions that get into some of the planning for people who are hitting that inflection point.
Totally. So we've got a big old laundry list of things that we're going to talk through today. And these are just patterns, right, that we've seen over time. It's not specific advice. In fact, a lot of these are choices, right? So have you thought about this choice and the ramifications of it on other elements of your financial life? So yeah, not specific advice, as we can't give specific advice without talking to people, but these are the questions that you should be asking and decisions you should be weighing if you haven't been.
Yes, absolutely. Patterns. We do so many plans that we start to see patterns. So if you're a high income earner, let's just start with we're going to talk about a couple different topics, but let's just start with the 401k, right? Your W2, you have a 401k. When we look at the 401k, it's such a great vehicle to make sure that you are digging in, maximizing. Every 401k is a little bit different at employers. And so questions to ask to make sure that you're maximizing yours. And I think about the 401k in layers, and when we analyze them and do, a 401k sweep, we take it layer by layer. And so the first is just additions, right? How you're contributing. And I really mean that, how much you're contributing, right? Because some people have, when they hit that inflection point and their income goes up and they're contributing so much into their 401k, they max it out early. So what I mean by that is they hit the IRS limit
Mhm.
earlier throughout the year. It could be July and their 401k is already maxed out.
Yep. Yep. Yeah, the example I always think of with that, you might be familiar with the term dollar cost averaging, but I think of 2022 when the market took a nice dip in the fall. And yeah, if you had maxed your 401k out early that year, you had bought the market when it was more expensive and then failed to buy it when it was cheaper. And if we knew when the market was going to be up or down, like, yeah, we just put all our money in when it's down. But the thing is, we don't. And so the best strategy really is to spread your contributions out evenly.
Yes, because you want to be buying throughout the entire year, right? Or averaging the best price of the market when you contribute. So, another horror story on this is there was actually, I was working on a plan with another advisor, and their specific 401k stopped matching him when he stopped contributing because he had maxed out.
Right.
And that was within the matching provisions of the K plan where, he had stopped contributing and he hadn't received the full match, right? Because they were matching a contribution, not a dollar amount.
Yeah. And I think that even underscores the misconception of, oh, yeah, like every 401k probably is all the same. Like, no, they're actually not. And they're beholden to a plan document that's written. And that plan document just has so many different ways that it can be created. So in this employer's situation, were matching a percentage of the contribution, not an actual dollar amount. And so by them stopping contributing for half the year, they were missing out on half of the employer's match, which really stinks.
It really stinks year after year, right? So that's the first like baseline, how I'm contributing layer. And you can find that document, the summary plan description,
Yep.
on your portal typically under like a, plan document section. So it's called an SPD or summary plan description. So, okay, then how am I contributing? What about the tax wrapper, right? If I have Roth, if I have pre-tax, some 401ks allow for after-tax contributions. So that's the next layer, right? Is the tax layer. Am I trying to pull a lever for a strategic deduction I've worked out in pre-tax? Am I trying to, grow dollars tax-free in Roth? Am I trying to do a mix of those? If my 401k has after tax, am I
Hmm.
utilizing that in some kind of backdoor fashion? Um, or for other reasons. So there's that next layer of question that you need to ask.
Yeah, and I think the really important thing here is the decision you made at 25 probably doesn't have the same variables that you would make at 35, probably doesn't have the same variables you'd make at 45. So, 401k plans are like they have contingencies built in so that you can set and forget them. But setting and forgetting them often means that you're leaving some pretty big efficiencies on the table, and tax wrapper is just enormous. So, like, not revisiting that over time, like you might have made a really strategic decision 10 years ago, maybe with the help of a financial planner, but it's 10 years later. And does that decision still make sense for you?
Yeah, this is one of the bigger, badder levers that if you're working with a financial advisor who's helping you with tax strategy, that they can pull and utilize. So really understand the provisions within your plan, even the amount, because some 401ks increase the amount that you can even add past the, in 2025, 23,500, right?
Yeah. Yeah. That actually just brings to mind we had a client email us early this year, early in 2025. 401ks change. Their 401k had just added an after tax provision. Previously, you could only add up to the IRS limit, and they had
Mhm.
just added a provision allowing you to contribute above that. So 401ks aren't necessarily going to stay the same either, which is another reason not to set, forget, and never think about it again.
Yep, and that makes me think of kind of the next layer, which is the investment layer, where your plan provider or advisor might be adding in new investment funds.
Totally.
And a lot of people, so the investment layer, okay, so the investment layer, um, what's actually working and growing your money inside of the plan, and this is another a lot of people just sign up and they are in kind of the set forget target date fund or life cycle fund, 2040, 2050,
Hmm.
whatever. And they're completely unaware of potentially, the other options that the plan offers. And they just kind of stay away from the do it yourself button because, they just want what everyone else is doing or what HR told them to do or
Yeah, or on the flip side, they do the do it themselves button and end up with a really disadvantageous mix.
oh, true. Yeah, we've seen that too. So, okay, so the investment layer, high level, a lot of times there's kind of the cookie cutter funds, target dates, targeting a date, maybe 15 of them or so, right, on average. And so these are funds that they are just automatic, they're rebalancing, targeted on a date, right? If it's 2060, it's typically getting, more and more conservative the closer it gets to that targeted 2060 date if they're going to retire at that point, which a lot of people don't want, right? If they don't want it to be buying cash and bonds, or sometimes those funds charge more to do it. And so people know that they have some other efficiencies. So this is a good question to ask, right? What other
Hmm.
funds are available within my 401k, right? What's kind of at the end of the list there that, I maybe they're cheaper, maybe they're higher performing historically speaking.
Yeah.
And so creating an advantageous, efficient mix within that plan, or maybe you're gonna say this, but even looking to see if there's a brokerage link. Like there's just
Hmm.
again, these are questions that you should ask because this could be 20 years of income and growth compounding on itself.
Yeah, for sure. Yeah, and I think even just a step back for a moment, like target date funds are actually an incredible behavioral backstop if you're not working with a planner. Like the
Right.
fact that you can just put money in, it's invested well, it's diversified, there's not diversification mistakes. There might be fixed income mistakes where it just doesn't match your risk tolerance or your time horizon, but they're an excellent backstop. And I think this is really a point where you can level up if you're working with an advisor, right? So, you know, past performance is not a guarantee of future results, but a lot of times, actually, I can't think of a time in recent memory where we haven't been able to look at a mix or at options available in a 401k and put together a mix that is beating the target date fund with historical returns, right? So it's an option both for efficiency on fees because you typically are going to pay less for the at least the index funds within a 401k compared to a target date fund. And those index funds, when put together properly in a diversified manner, often are going to return more than what the target date has been returning, without pushing you outside of your desired risk tolerance.
Right, and these are all patterns, right? So we're not saying this is the way for your 401k, this is the case in your specific plan, but these are patterns that we see, so questions that you should
Yeah,
ask.
some 401ks do have really crummy investment options. So it is not a guarantee that you're going to do better in the choose it yourself funds. And also, yeah, be aware if you're going to just choose your own mix too, because that's something that you typically are going to want to professionally manage, and that's an advantage of the target date fund if you aren't going to engage somebody else for professional advice.
This is the reason we're bringing this up, right? Because at that inflection point when, okay, I'm making more, I have more, I wanna be efficient, I wanna, put thought towards this wealth and stewarding this, and this is just one of those inflection points where an area where you can level up. And so people who wanting to dig deeper, this is a question you can start with asking. Okay, what else?
Yeah, let's just hit a few of these additional things. These are smaller things. Well, I mean, they're meaningful, but just things to check and see if you have aware, under the banner of every 401k is different, right? So, a few things to check and ask yourself. Does my 401k allow me to add above the 23,500, at least that's the 2025 limit, via a vehicle like after tax? Is that available to me? Because that's an enormous, totally different lever that is outside of regular contributions.
Right, and even within that, I have to put a caveat because if there is this option to put in an extra, what is it,
Yeah, it depends
40,
on your employer's match, but
yeah,
getting up to 70,000 this year is the IRS maximum of contributions.
right. So within your traditional contributions, your employer match, and then potentially, this after tax door opener. Some companies call it a mega backdoor. But if you can add into that space and get up to that 70,000, then there's a few other questions that you need to ask because a lot of times, and this isn't advice, but a lot of times, I don't prefer that money to actually sit in after tax. If you have that door, that window, I just 9 times out of 10 don't see an advantage to money sitting in after tax, right?
Yeah.
Not Roth, not pre-tax, but that after tax. And so then you have to ask questions of do should I, from a tax perspective, make in-plan conversions? Does my 401k even have an in-plan conversion? Can it be immediate? Can it be day of, right? So you put the money in and bam, it's converted. So many mistakes here, but at least hopefully this, gives you some questions to start asking.
Yeah, in-plan conversions is a really important umbrella, and it can look several different ways. Last year, I had to hop on the phone with a client and call their 401k provider in order to turn on automatic in-plan conversions because their portal didn't actually allow it. So there's plan document differences, there's technology differences. There's a lot of ways that it can actually work out.
Yeah. Last two things. Yeah, make sure you have the right beneficiary. Make sure it's labeled correctly. Big deal. And then, yeah, as far as matching, just some look to see if it's all being matched in pre-tax or if you have the ability to be matched in Roth and what makes sense from you from a tax perspective. That's new this year is employers matching in Roth. So we've only seen a company or two do it, but that's something to ask. So okay, let's move away from the 401k. Let's jump into tax, which is, oh, this isn't tax advice, and this is a big, meaningful space, especially for high income earners. It's just so specific to you. So we're gonna give you some questions that you can ask yourself, but be aware that ultimately
Yep. Yep.
these are just questions that you might not have the answer to.
Right. Yeah. This is big category number two, right? Because like the 401k is a lot of people's
Mm,
main vehicle for retirement savings if they have it available, right? But now we're talking about in year and long term tax efficiencies. And there's a term that we have been trying to use more and more often because I think it's really instructive. It's called tax maximization. That doesn't mean trying to pay as much tax as possible, but it means maximizing advantageous tax moves. And sometimes advantageous tax moves do mean paying more tax now and choosing to control your tax wrapper or your tax bill as opposed to always pushing things down the road. If you always push tax down the road, you could end up with unintended consequences that constrain you later in life. So I know I just went off on tax maximization, but I think it's a good conceptual overlay for how, the questions that we ask about tax.
right. Yeah. Tax planning wrapped up is either increasing your income or decreasing your income both have strategy, and both are strategies when you look long term, trying to control your tax landscape, soaking up ideal brackets or not.
Hmm.
And so this is trying to reduce your overall long term tax drag. And so, just a few questions. We are not going to hit them all, but I just made a list of, again, patterns, right? Themes. Does my company have an HSA? That's the only triple tax advantaged account, right? Does my health, align with a health plan, a high deductible plan that could pair with an HSA? And how am I using it? Am I investing it? But that is a triple tax advantage, right? And for high income earners can, yeah, save thousands in tax.
Yeah, yeah. So the 2025 family contribution limit is 8,550, and that's just a deduction that you get on your taxes. And like Allison said, it's triple tax advantage, right? So any growth in that account is tax free, and then it comes out tax free, provided you use it for medical expenses. So yeah, this is a powerful account, although relatively small in the big picture of things.
Right. So right now we're talking about income decreases, strategic income decreases, or a CPA would say deductions, right?
Mhm.
So we're going to talk about decreases and then increases that are strategic as well. So another big lever for an income decrease is if maybe this particular year you want to pull the lever of the pre-tax 401k. I've been adding in Roth, but you know what, this year, looking at my overall long-term tax drag, it makes sense to take an in-year deduction and switch to pre-tax,
Yeah.
right? Again, another lever. Or make a donor advised fund contribution if you're charitable, right? Or even in your investment accounts, is there like a brokerage taxable individual or joint account? Is there an opportunity for me to harvest losses? It's called tax loss harvesting, right? Or swap stocks that are advantageous that will actually help me from a tax perspective.
Yeah.
Like similar stocks like Pepsi and Coke, and one's up, one's down, and I can actually capture, a loss and, help my taxable income.
Yeah, and I think even to just zoom out on the deductions for a moment, like a lot of what we're talking about and thinking about here are when you have peaks and valleys of income, but particularly with deductions, peaks, right? Are you getting a really large bonus, a large equity compensation payout?
Mm.
Say you're getting several hundred thousand of company stock that you are being taxed on this year, and you're charitably inclined. Maybe you want to make 10 years worth of donations to your charity of choice into a donor advised fund the year that you have a peak, so that you're not taking money out of your bank account the next 9 years, but you've effectively reduced your taxable income and reduced the income that's in higher tax brackets in this year where you get the big payout. So I just want to back up for a moment and think concretely of like, okay, what are some of the triggers where we might want to really look at minimizing tax for a current year and the ways that you can do that?
Yes, income spikes are some of my favorite times to plan. So when you're receiving a large, whether it's an inherited IRA or you got a huge promotion or you have a huge equity comp, that's vesting, and it income spikes have so much opportunity for planning, and it might delay decisions that you would make. It might delay selling your home, selling a certain stock in your portfolio that's going to push you into the higher capital gains rate, or other strategies you might look at for these strategic deductions that you're working through with a financial planner and saying, and CPA, and saying, okay, we're coming together and we're going to make this strategic deduction, this move to get a deduction, I mean, because of this income spike.
Yeah, and I might even just highlight one more that you touched on briefly of should I consider waiting to sell certain assets this year? Just a thing that I haven't seen many people be aware of is the capital gains tax bracket. So when we're thinking of selling homes and selling traditional assets like stocks that have a gain on them, you have a capital gains tax bracket that is calculated similarly to your ordinary income, but on top of the ordinary income you earn in the year, it also starts to, or it tracks gains. So if you have $200,000, of a gain on a home, that adds to your capital gains tax bracket for a year. And people don't always think about this and can inadvertently push themselves into a higher capital gains tax bracket on a high income year.
Okay, so questions to ask about strategic income increases. So we're still in tax. Wow, we've been in tax. Well, the tax is so hard because it's so specific.
Yeah.
But let's just run through a couple opportunities where we see that it's advantageous for a client to make a strategic increase in income, which sounds wrong, but again, think overall tax drag, right? Soaking up advantageous tax brackets if we have a little bit of a wiggle room, right? If there's some wiggle room in the 24% or you know, it, that's when strategic increases may or may not make sense.
Yep, yep. Yeah, and I think, even terms that so soaking up favorable tax brackets is, if you've talked to us, a term that you might have heard Allison say. I think even just double click on that. Like, what we really practically mean is, maybe your total income for the year is right smack dab in the middle of the 24% federal tax bracket, which in current tax law, we consider that a pretty advantageous tax bracket and tax range. So when we say it's like soaking up, it means, okay, maybe there's $50,000 between me and the 32% federal tax bracket. Do we want to consider a tax maximization strategy where we choose to pay more income or to realize more income in this year so that we can lower our long-term, multi-year, multi-decade tax burden? So that just to even unpack a little bit what we mean when we're saying tax maximization or soaking up a favorable tax bracket.
Yep, exactly. And one way where you would, and you may have heard this term, Roth conversions, that's one way where you would soak up, right? So when you make a Roth conversion from, for example, IRA to Roth IRA, or if your 401k allows, within there, but that shift and conversion of money it increases your taxable income. So that would be a soaking up, right? Because you've decided with your financial planner that, okay, this year and to the best of our ability looking forward, it actually makes sense to soak up my favorable bracket at this time.
Yep. Yeah. A lot of this has to do with Roth, right? Because to contribute to Roth, you're choosing to pay tax this year. To convert to Roth, you're choosing to pay more tax this year to move those funds into Roth. But even like, another flavor of this, inherited IRA. So if you have an individual retirement account that has been passed on to you, there are distribution rules. They changed in 2020. So it depends whether you inherited it before 2020 or not. But regardless, you are going to have some rules about how and when you need to distribute it. Might a current year, as you look forward, it might be more advantageous to take more out because, right, it's a big pot of money that hasn't been taxed that you're going to have to pull and get taxed on. So there may be a year, it could be this year, it could be an upcoming year, where you see a valley of income coming up and it's like, well, let's fill up some income from this IRA and get some of that tax burden off our balance sheet.
That is so well said. If there are peaks and valleys that you can determine because, oh, I'm going to make more money this year, or I'm going to take a 6-month hiatus from working this year, or I'm making income deduction strategies this year, so I'm going to withdraw more from that inherited IRA.
Mhm.
This is what we're talking about.
Right, exactly. Yeah, and that's how these things start to play with each other, right? If you are doing a Roth conversion and raising your income, maybe that's your move and you don't necessarily want to pull more from an inherited IRA. But yeah, like you said, if it's a higher deduction year or a lower income year or a combination of both, then getting more of the inherited IRA into the bank account outside of the tax deferred space may make more sense.
Absolutely. Yeah, so and there's different ways you might choose to get money into Roth too if we kind of go back to the Roth conversions, right? It might not be through Roth conversion, it might be through just a Roth contribution or a backdoor Roth IRA or that's currently allowed within current tax provisions. So there's different levers here and they all work together and that's really where especially if you're thinking about soaking up or, increasing income, so sucking up in your current favorable tax bracket, that's when you wanna be really aware of your surroundings and other levers that you might be pulling.
So let's move on to just some final housekeeping. So we're talking about somebody or a family who's making more money than they need. They're probably outgrowing some of the systems that they set up earlier in their career. What are common patterns that we see in people in this situation, just from a housekeeping perspective?
Yeah, so a little bit of a laundry list, but again, themes that we see is 9 times out of 10, these people have too much in cash.
Mhm.
And also the amount that they should have in cash, it isn't in the most cash efficient vehicle, right? It's just sitting maybe in a bank or, high yield savings, which sometimes that's not this past year the best place, but in our opinion, but it's just the cash isn't in the right place and there's too much cash.
Yeah.
But they're just kind of paralyzed as to like, oh, I haven't known, what to do with it. So they know they're at this inflection point. They want to press deeper. It's just and it usually ends up with too much cash in the bank account.
Yeah, it is kind of fascinating. I mean, not everybody, but sometimes people can get really worked up about, what their investment return is going to be. But then they have 100,000 sitting in a cash checking account that is giving them 0.01%. And they're not thinking about how, some rates that I've been seeing recently, like a high yield savings even, right, is maybe 3.5, 3.6. A money market, I looked at recently, 4.2%, right? So I think sometimes people are looking at a forest and then not like identifying some of the important trees within it where, yeah, they're building up cash and just having it in even a really cash inefficient spot.
Yeah, and this is when you start to ask, what's the goal of this money, right? And so sometimes we need a 3 month, 6 month, year emergency fund. It kind of depends on who we're talking to and what the goals are. But ultimately, or if we're a retiree, it might be even 2 years, but it's just looking at that amount and then clipping off the fat and saying, let's put this money to work. And I think that actually brings people a lot of peace. But okay, so too much cash, we talked about this one, but have you had your tax return reviewed by your financial planner? And have they, kind of given your CPA the green check mark of they're doing good work? We're able to work and communicate with them and collaborate. This is important for high income earners.
Yep. Yep. 100%. Another one for housekeeping, as we think about income becoming more diverse, income becoming higher generally, a lot of times people don't end up solely getting their income through salary. I mean, it depends on the company you're at. A lot of times companies diversify income into different equity incentives, whether that's restricted stock units or options or, yeah, different types of grants. So, do I have a strategy for using that? Because it's so different than receiving just a salary or bonus in your paycheck when you start receiving equity, different tax implications. And then obviously you've got, in some ways, your net worth and your compensation tied up in the market and in the market of a single company in this case.
Tax implications, concentration implications, so much planning to be done there. We're actually going to do, or we just did a podcast on that. So go listen to Equity Comp. Need a plan. The other thing I think is just cash flow systems and efficiency, especially when you're W-2 and you can plan, right? Sometimes business owners can't plan as well, or commissions or sales can't plan as well. But if you're able to, you have your salary, maybe bonus, you're really able to plan and maximize dollar cost averaging from a cash flow perspective. I have this much going long term in these different buckets. I have this much going into my midterm flexibility bucket that's invested. And I have this much going into short term goals that isn't taking on risk, right? So there's this system that typically monthly we have people adhere to because they're able to plan as a W-2.
Yeah, and I think even similar to the 401k conversation, there are benefits to investing consistently, strategically throughout the year. You don't want to just get in a habit of looking at your bank account every once in a while and just toss an extra cash in just because it's there. I mean, that you're doing the thing, but you're maybe not doing it as efficiently as you could be if you had systems in place.
Yeah. And I think that's a good place to end because all of this, I mean, that's a long list of questions to start asking yourself. But ultimately, this is designed to start to highlight themes. And those themes are bringing together tax, investment, even retirement goals, and all these things that matter. But ultimately they work together. And so it's just time. These people know it's time to plan, it's time to dig in. They're hitting that point where their income, they're they're people that can live within their means, but they just don't need everything that's coming in. They want to put it towards future flexibility. And that's where pulling these tax levers, pulling these, investment levers or harvest, all of this starts to really matter. Not that it didn't before, but it's just the multiplier gets bigger and bigger.
Yeah. Yep. 100%. And this is, I'd say the sum of these factors is a big part of the reason people reach out to us when they're in mid-career is a lot of times folks in this case or in this stage have they've been really responsible, they've been really thoughtful, but they realize that their time is valuable and they they don't have the time to figure it all out. And they also realize their expertise is valuable and that they have expertise in other areas, but not necessarily this area. And so both time and expertise aren't quite adding up. And so they're ready to level up and ready to hire somebody to help them make sure that they're doing the most that they can with their money.
Right. These are smart people. I mean, they've been kind of DIYing it up until, now, maybe using the S&P 500, but they're ready to level up. Or maybe they've even worked with a planner, but they know that they can do more. And so that's the goal of this podcast is to say, yes, you can do more. And here are
Hmm.
some of those questions that you can start to ask, that are going to elicit those places that you can do more.
Yep, 100%. And like we've said throughout this podcast, it's education, it's not personalized advice, but if you are interested in trying to figure out if there's a personalized plan that makes sense for you within all of these factors, you can certainly reach out to us and we can have a conversation and turn this laundry list into something that is personalized to your exact situation.
Right, exactly. Dialed into something that's meaningful to you and your goals. So just look at the website, contact us, you fill out a form, and that's how you can get in touch. But a lot of people are, finding that inflection point and increases in income make it a really good time to do that.